Following our recent analysis of Eve Holding Inc., today we pivot to Redwire Corporation. They're a significant player in the aerospace and defense sector, market cap around, $1.58 billion, specializing in space infrastructure, components, and they've also notably expanded into drone technology recently.
Right. And the core issue today, I think, is this fundamental tension. How do you square Redwire's big strategic push into these really critical space and defense areas with the fact that, they're deeply unprofitable right now and face some pretty serious financial and, frankly, legal risks?
Exactly. And I'll be making the case that Redwire's long-term vision, its strong IP portfolio, and, those bullish analyst forecasts, they all suggest it's actually significantly undervalued.
And I'll be focusing more on the, let's say, the immediate financial picture, the instability, the, frankly, poor profitability metrics, the stock's high volatility, and these historical accounting issues. I think all that needs to seriously temper any excitement about the future, regardless of contract wins.
Okay, so from my perspective, Redwire really represents a classic high-growth opportunity. It's in a critical sector, national security, space infrastructure, and I believe the market is fundamentally overlooking its future revenue potential. My conviction here is really built on their aggressive strategy. They've successfully integrated key acquisitions like Edge Autonomy. That's a defense drone maker. Gave them instant access to the UAS market. Plus, they are securing these major long-term space contracts. Think about the rollout solar arrays, the ROSA tech for Axiom Space's first commercial station module. It enables high-power generation in low Earth orbit, which is exactly where the commercial space economy is, exploding. And we're also seeing validation from defense wins, like the prototype contract for the Army's long-range reconnaissance program. Now, look at the valuation strength. The price-to-book ratio, PB, is sitting at 1.49. That is dramatically lower than the industry median of, 7.51? It strongly suggests the stock is, deeply discounted on a book value basis. And finally, look ahead. Analysts project forward EPS next year improving massively, from negative $3.25 trailing to negative $0.23. That indicates a clear, quantifiable path toward better execution and financial health.
See, that narrative, the potential growth story, I think it obscures a really troubled financial foundation. I respect the strategic importance of the contracts, ROSA included, but potential doesn't pay the bills today. The trailing 12 months net income, negative $249.63 million. That's a colossal loss. It results in a staggering profit margin of negative 95.52% and a return on equity of negative 45.35%. That negative ROE, it basically signals the company is actively destroying shareholder value right now, not creating it. Now, you mentioned the low PB, but let's flip that coin. Look at valuation based on revenue. The price to sales ratio, PS, is 6.03. That's nearly double the industry median of 3.23. So based on their actual current sales, about $261 million, the stock is trading at a considerable premium compared to its peers. How does that square? Selling assets cheaply, but sales are priced expensively? And finally, investors have to deal with that high beta, 2.48, extreme volatility, high uncertainty. This screams speculation to me. And, I come at this from a slightly different angle too, focusing on the huge split in what people think this company is actually worth, the intrinsic value estimates. This is where the speculative nature, I think, really becomes clear. The average analyst target, it's incredibly bullish, $17.94, predicting massive upside.
Right.
Yet, the more conservative models, especially discounted cash flow, DCF models, which by their nature reflect the failure to generate free cash flow, they estimate the intrinsic value is way, way lower, somewhere between, say, $4.85 and $16.16 per share. So how can we possibly trust that extremely optimistic $17.94 analyst target when the conservative math suggests the current share price, around $9.54, is already pushing or even past fair value? The only way you bridge that enormous gap is through, pure speculation on future hopes.
For me, it highlights the immense optionality that's built into Redwire's business model. It's something these conservative DCF models frankly just can't capture properly. That analyst consensus, It's not based on today's negative cash flow. It reflects the high potential terminal value of their intellectual property. We're not just talking about selling widgets here. We're talking about IP like the ROSA solar technology, their work in space 3D printing, advanced manufacturing. These are technologies that position them potentially to dominate the next wave of space utilization. It's IP that could generate massive high-margin revenue years down the road. And going back to that low PB you noted, it actually suggests they were pretty shrewd in acquiring the underlying assets and these heritage firms relatively cheaply. Look at the balance sheet. It's strong enough to weather this expansion phase. Debt to equity is remarkably low, 0.42, and their liquidity is solid, current ratio of 1.46. That financial runway, well, it gives them the time they need to convert that $261 million in trailing sales into genuinely profitable revenue. And that's precisely what we see anticipated in that massive expected EPS improvement you mentioned earlier. Now, let's talk about this strategy. Aggressive growth versus focusing on immediate profit. Redwire has, I think, executed a pretty disciplined strategy. They've combined these heritage firms with acquiring disruptive capabilities like edge autonomy that effectively transitions them into becoming a global defense tech disruptor. And this strategy, it's fueled a robust 3-year sales growth rate of, 30.26%? And I really maintain that in a sector like space infrastructure, defense tech, which is highly competitive, evolving incredibly rapidly, this kind of aggressive expansion and IP accumulation is absolutely essential if you want to establish long-term market leadership. Delaying immediate profitability, well, it's arguably a justified cost when the prize is securing a permanent strategic position in the high-value defense market.
But the core issue, for me, remains operational efficiency. I'm just not convinced by that line of reasoning because the cost structure appears unsustainable right now. And that gross margin, it tells a really devastating story. A gross margin of only 2.53%, that is extremely low for a high-tech manufacturer doing complex, mission-critical work. It implies that for almost every dollar of revenue they bring in, 97.5 cents are immediately consumed by the cost of goods sold. That massive disconnect suggests that even though sales are growing by 30%, they're getting virtually no operational leverage from those new sales. So you have to ask, are these new contracts just low-margin volume plays designed to prop up the top line? That TTM loss, nearly $250 million, that's not just a paper loss. That's the astonishing rate at which they're burning through capital. At that rate, even with the decent current ratio you pointed out, every single quarter becomes a race against the clock. We need to see concrete evidence, not just press releases about new contracts, that they can actually execute on high-margin operations and get serious about cost management. Specifically, they need to tackle that negative operating margin, which currently sits at negative 39.97%? That needs to turn around. Now, let's pivot slightly to something that often really dictates how investors feel: confidence and governance. Several 10% owners, BCC Redwire Aggregator, Genesis Park 2 LP, they've recently reported pretty substantial sales of shares, both proposed and completed. That kind of institutional selling often indicates waning confidence from the sophisticated money. And compounding this, the company has faced significant legal scrutiny. You can't just dismiss this as ancient history. They finalized an $8 million settlement for a securities class action lawsuit. And that suit was related to misleading statements about accounting issues and internal financial controls. That type of settlement concerning governance and financial transparency, it suggests a potential systemic operational risk that can linger much longer than the immediate cost of the settlement itself. So these factors combined, they paint a pretty clear picture of elevated legal and operational risk, which for me makes the stock just too uncertain for a long-term commitment right now.
Large, initial institutional holders, often those involved in the SPAC process, have sold off substantial positions. But we really need to contextualize that selling. A lot of those large sales are quite common post-SPAC formation, especially when lockup periods expire. It's often just planned portfolio management, not necessarily a sudden vote of no confidence in the core business itself. And crucially, there's countervailing data. We see recent purchasing activity by the company's own executive team and directors. The CEO, the CFO, other officers, they've reported insider buys in early and mid-2025 at various price points. This internal buying, even if it's smaller in total volume than the big institutional exits, it suggests that the leadership team, the people closest to the actual operations and execution, are willing to put their own money on the line. They seem to be betting that they can successfully execute this turnaround plan and overcome those documented past operational challenges. So, to summarize my position, Redwire's deep strategic focus on high-growth defense and proprietary space programs, which is validated by these major contracts, and their smart integration of critical tech like ROSA and AI-powered digital engineering, it really suggests that the current market price significantly undervalues its long-term strategic position. That extremely low price-to-book ratio points towards favorable asset valuation, and the strong balance sheet provides the necessary runway to eventually realize the optionality inherent in their high-value IP. They could become a key builder of the next-generation space economy.
And conversely, from my side, the current financial profile, dominated by those massive net losses, the severe negative margins, and these high valuation premiums relative to current sales, it dictates extreme caution. The operational inefficiencies, starkly highlighted by that negligible 2.53% growth margin, indicate that the impressive sales growth just isn't translating into meaningful operational leverage yet. Until Redwire demonstrates a proven ability to prioritize disciplined capital allocation and actually convert its extensive contract pipeline into sustained, profitable cash flow, the high volatility and these wide discrepancies in intrinsic value estimates just confirm that this remains a highly speculative investment. It's driven much more by future hopes than by current financial reality.